This voice is taken from an article with the title, "What is the Impact of Interest Rates on Currency Prices?" which has been published on TraderTalks.net. Interest rates have a direct impact on currency prices. When a central bank increases its interest rate, it causes investors to move their funds from other currencies to the currency of that country, and this increased demand for the currency drives up its price. Conversely, when a central bank lowers its interest rate, the demand for its currency falls, resulting in a decrease in its price. The reason for this is that when a central bank raises its interest rate, it is indicating that it wants to make its currency more attractive to investors. This means that investors can earn a higher return on their investments if they buy the currency of the central bank that increased its interest rate. This increased demand for the currency leads to an appreciation in its value. Conversely, when a central bank lowers its interest rate, it is indicating that it wants to make its currency less attractive to investors. This means that investors can earn a lower return on their investments if they buy the currency of the central bank that decreased its interest rate. This decreased demand for the currency leads to a depreciation in its value. The relationship between interest rates and currency prices is not limited to the relationship between a central bank and its own currency. When a central bank raises its interest rate, it can also impact the prices of other currencies. This is because when a central bank increases its interest rate, investors may move their funds from other currencies to the currency of the central bank that increased its rate, causing the other currencies to become less attractive to investors. In addition, the interest rate of a central bank can also have an impact on the prices of its assets. When a central bank raises its interest rate, it increases the cost of borrowing, and this can lead to a decrease in the demand for assets such as stocks and bonds. This decrease in demand for these assets can lead to a decrease in their prices. Similarly, when a central bank lowers its interest rate, it reduces the cost of borrowing, and this can lead to an increase in the demand for these assets, resulting in an increase in their prices. Overall, the interest rate of a central bank has a direct impact on the prices of its currency and other assets. When a central bank raises its interest rate, it leads to an appreciation in the value of its currency, whereas when it lowers its interest rate, it leads to a depreciation in the value of its currency. Additionally, an increase in the interest rate of a central bank can also affect the prices of other currencies and assets.